Hi, welcome to On Investors' Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to learn about what investors are thinking about right now and how that fits in with building the right portfolio. Now, since April, following the announcement of tariffs by President Trump, many international and Asian investors have been questioning the need for global equity diversification. This has been partly driven by the relative outperformance of European and Asian equities since the start of the year, as well as the concerns over U.S. policy and economic outlook. Since the start of 2025, we have been advising investors to diversify their equity allocation globally. At that time, the relative valuations of U.S. stocks versus the rest of the world suggested that U.S. equities were pricing in a lot of good news. Some might even say perfection. The concentration of earnings and market returns amongst a small number of large U.S. tech giants were also a weak link. After Trump's inauguration, the cutback in government spending through the efficiency drives or DOGE and significant policy swings in tariffs have raised concerns about the outlook of U.S. assets. However, we still see plenty of reasons to stay invested in the U.S. U.S. companies have an excellent track record of profitability considering their return on equities. There is one near-term issue with U.S. stocks. The S&P 500 and the Nasdaq have returned to levels seen at the start of the year after a sharp drawdown in April. This means the S&P 500 forward price-to-earnings ratio is back above 21.5, a number that you can get from our daily guide linked in the description. And you'll see we're back to the picture-perfect valuation level that we discussed earlier. Assuming we can avoid a recession in the US, we still expect some growth deceleration in the economy later this year. This means the current 2025 earnings forecast of high single digits is arguably vulnerable to downward revisions, which could limit strong returns for the rest of the year. And that's why we think investors should also be broadening out their allocation in equities, not just in the US, but also globally. For example, in Europe, the strong performance year-to-date has already lifted valuations above the long-term average, slightly. But nonetheless, its valuations are still relatively attractive compared to their US counterparts. Falling inflation means the European Central Bank can be more proactive in cutting rates to support economic growth. Additionally, European governments, especially Germany, are looking to step up fiscal spending on infrastructure and also on defense, providing a much-needed boost to the region's heavy industries. Japan is slowly moving away from 3 decades of deflation. Japanese workers' income growth remains high based on the most recent wage negotiations. This, alongside with strong tourist arrivals, should continue to support consumer spending. More importantly, the ongoing corporate governance improvement continues. Companies are buying back their shares in record amounts to boost earnings per share growth and reduce idle cash despite some of the more recent uncertainties. They're also reducing holdings of other company shares that do not create value for their shareholders. Over time, this can help Japanese companies to improve their financial metrics to be more in line with their US and European counterparts. Nonetheless, active management is still crucial to ensure that we invest in the right Japanese companies with strong intellectual capital that can compete internationally. We must pay attention to how the movement of the Japanese yen could impact on earnings as well as return to investors when converted back to their home currencies. For the rest of Asia, we've published several insights on the outlook of Asian equities. The first quarter of corporate earnings is decent, but tariff concerns is naturally on CEOs' minds. Some domestically focused sectors and services do show greater resilience. Moreover, Asian governments and central banks have some flexibility in supporting their economies. Themes such as AI developments in China and also the rise of the middle class in South and Southeast Asia continues to capture investor attention. Once tariff issue settles, we could see a realignment of global supply chains benefiting these regions. In short, we're not necessarily predicting a sharp US equity market downturn, but the outperformance that we've seen in the past few years relative to other international markets could be hard to sustain. The potential for a weaker dollar could also boost the appeal of international assets and equities from a total return basis. We believe that there are good companies around the world, and that's not limited to just the US. So thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues, and of course, consider subscribing. If you have any topics that you would like us to cover or discuss, please reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you in the next episode to discuss what's on the investors' minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.